Joining us to discuss this morning, Goldman Sachs head of investment grade credit, Jonny Fine, is back at Post 9. JF, it's great to see you again. Thanks for coming in.
Great to be on. Thanks for having me.
What you're thinking right now on what they will do, should do?
So I think they will cut. I think they should cut. I think they will be hawkish in terms of the rhetoric following that cut in the press conference, and I don't think they should be. I think they should be very, very patient and allow for the official data to come through to see and lay bare exactly what's going on in the labour market. My strong suspicion is that the labour market is weaker than it looks under the surface. We'll get a lot of this information over the course of the first few weeks and couple months of 2026. And I do think that the Fed will ultimately embark on a deeper easing cycle than the market currently has.
So you see unemployment, the rate, rising dramatically?
Not dramatically, but steadily and impactful enough so this becomes the A1 focus of the Fed. I think inflation will continue to migrate towards target probably by mid-late of next year, but I think the labour market is going to come into view much more sharply, and I think the Fed will be very, very keen to counteract negative pressures there very quickly, and we'll move into a more easing posture pretty soon into the new year.
Agree with everything you just said, but then we get a job openings report like this, which was very strong in terms of the amount of openings, or the weekly unemployment claims number, which is historically low and bodes pretty well, or job growth, which is still happening, even though we don't have the last few months of data. So it's kind of mixed messages.
Yeah, there's noise in the alternative data, there's noise in some of the official data, and none of this is going to be in a straight line because it never is. But I do strongly suspect that as we move into next year, some of the productivity gains that we'll see as a function of technology and AI adoption will really be felt. And as a result, that labour market weakness and labour market rebalancing that will need to take place will need to be assisted by meaningfully easier monetary policy.
Even if it means stubbornly high inflation?
I don't think inflation will be stubbornly high.
You think it's going to come down?
I think those productivity gains will allow the cost of goods sold to go down. I think that will be a net win for the consumer. I think it'll be a net win for margins. And so overall, to be clear, I'm actually really bullish growth in 2026.
Why?
So I think that the ongoing movement of the economic growth going in one direction, but the labour market going in another direction, I don't even think we've gotten started on how that move is going to develop.
High GDP,
high unemployment, requirement to move interest rates sharply lower than they are today. And I think it's going to be driven by the adoption of AI and other technological advances in the corporate sector. We're at the very, very early innings of it, but I'm more in the Elon Musk camp of this being a huge unlock of productivity, a huge benefit to the overall consumer and to the real economy. And by the way, like all of these things together, great growth, lower interest rates, terrific for the US government as we think about the fiscal balance as well.